Get Rich Education is brought to you by Norada Real Estate, the Real Asset Investor, and Highlands Residential Mortgage.
Are you having a hard time finding great investment properties? Unfortunately, the best deals are rarely found locally. Successful investing begins with the right properties in the right markets. Norada Real Estate provides everything you need to invest in the best deals across the U.S. Our simple, proven system will help you create real wealth and passive monthly cash flow. Get your free copy of the ultimate guide to passive real estate investing at noradarealestate.com/guide. That's NORADA realestate.com/guide.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Hey, here it is. Welcome to Get Rich Education, episode 130. Hi, I'm your host, Keith Weinhold, back to help you build your wealth. We've got a great guest today, but first I want to mention that the U.S. housing squeeze just continues to intensify. We're really getting into a tighter than tight housing market in a lot of metros. In some markets, buyers are jumping on listings within seconds of them being posted. Wannabe homeowners are burrowing themselves into these ever scarcer, ever busier open houses and going a little mad trying to get in the first bid. Real estate agents are knocking on hundreds of doors just to try to squeeze out one more sale listing for themselves. And one place that's really emblematic of this squeeze is Seattle, Washington, which is a place where we wouldn't recommend investing here, of course, because we're cash flow centric investors, and that's not where the cash flow is. But what's going on in Seattle is just really interesting, and it tells you a lot. It's been estimated that in King County, Washington, which is where Seattle is located, that there are 120 new jobs being added each day and 143 more people being added each day, but yet there are only 41 new housing units being added each day, and that's when you start to get an idea of the magnitude and the depth of the problem. Seattle has a blazing job market. The city has a seemingly unstoppable tech industry, and that's what's been powering double-digit price increases, and it just leaves buyers competing hard for a dwindling number of houses. In fact, in Seattle, only 1 in every 263 homes that you see is for sale. So while the tech economy really, in a sense, is relatively new there, the housing shortage is not. In fact, according to the Seattle Times, around 65% of Seattle's land is zoned only for single-family homes. So that blocks developers from building high-density apartment buildings in so much of the city. And then there are the foreign investors, too, who have snapped up much of whatever spare inventory has existed there. See, sometimes in a market, it's not just what that market's government policy is, but it's how a neighboring government policy can shape a local geography like what's going on in Seattle. And a good example of this is that last summer, nearby Vancouver announced a 15% tax on foreign property investors, and that sent a lot of would-be Vancouver investors straight across the U.S. border to Seattle. And lots of these investors are holding on to property with no immediate plans to inhabit it either. And that's a trend that has some people worried. Okay, buying houses without occupying them, that's really bubble-like behavior. So I guess my point is that there are a lot of interesting factors at work here, not just the obvious geographic isthmus that Seattle is essentially on, which limits supply, but a number of other factors that just don't immediately meet the eye. And by the way, I find it funny when some people talk about how investors want to avoid being invested in a bubble. Well, actually, the truth is that you do want to be invested in a bubble. Did you ever think about that? Yes, it's actually good for you to be invested in a bubble. Did you realize that? Yeah, because that probably means that prices have run up and you're the beneficiary of some good appreciation. See, you just don't want to be around when the bubble bursts, okay? That's when you get hurt. It's good to be invested when the bubble is expanding, just be out before it bursts. That's a risky game to play. It's really a game that we don't even play here. That's why we're cash flow centric. Whether the market goes up or down in value, we've still got that cash flow. So we invested instead of we speculated. That's what we say here when we buy those properties in stable markets, more so in the Midwest and South. Well, as far as the housing squeeze, it's not just the markets that you correlate with high growth, where housing inventory is being rapidly depleted across wide swaths of the U.S. You're seeing substantial decreases year over year of homes for sale in much of Buffalo, New York, and in a lot of the Michigan markets, too. And really, anyway, who are the biggest losers, really, in a lot of these skin-tight, depleted inventory markets across the U.S.? It's first-time buyers that have limited budgets, and that often means that they have to become your renters as higher prices and now higher interest rates just continue to keep them out of the home buying market. Lack of housing inventory just continues to be more and more of a trend. And that's, of course, also true in a lot of turnkey cash flowing real estate markets that we recommend here as well. Houses aren't like dollars where you can just instantly print an infinite number of dollars, and houses also aren't like stock shares where you can basically issue infinite fractional shares. Real estate is real. It has real value, and that's just one reason why we like it so much. I put an article in the show notes for you about all these U.S. markets where only about 1 in 150 homes or fewer are even for sale at all in these various metros. Well, we've got a great guest today where we're going to discuss one mindset concept and then at least 2 or 3 actionable items for you with how you can get a steady passive stream of income from making a commercial real estate loan yourself. Yes, that's where you're the lender. Let's meet him. Today's guest is America's Money Answers man and a nationally recognized expert on personal finance. He's a regular guest on countless television and radio shows across the country, answering questions on personal finance topics. He appears frequently on The View, Fox News Network, Fox Business Network, CNN, CNBC, and CBS Evening News. And for 18 years, he was on the editorial staff of Money Magazine, where he served as their Wall Street correspondent. And while at Money, he reported and wrote on virtually every aspect of personal finance. He served as the weekly financial analyst on the NBC News at Sunrise for 9 years, and he's the author and co-author of 13 best-selling books on personal finance, including the very popular book, Master Your Debt. With his decades of television and broadcasting experience, you might already know his voice because he is on your radio on KOA in Denver, WLW in Cincinnati, WHYN in Massachusetts, WFLA in Tampa, Florida, and many others, including KMOX in St. Louis, where he's been giving financial advice there for 30 years. Wow, that is inspiring. That is almost as old as me and maybe older than you. Welcome to Get Rich Education, America's Money Answers man, Jordan Goodman.
Great to be with you, Keith.
Jordan joins us from Elmsford, New York today. And something else, Jordan's name is on the cover of the gold-embossed Barron's Dictionary of Finance and Investment Terms. I know because I have it right here on my desk. He sent it to me last week. So yes, he literally wrote the dictionary on finance and investment terms.
Indeed, it first came out in 1984. The one you have there is the 9th edition. I did keep it to under 5,000 terms and under 900 pages, so you got to give me some credit for that, Keith, because I'm very succinct about these things.
Jordan, do you ever use that in an investment argument with somebody? If that person carries on for too long, do you just say, well, do you know who wrote the dictionary on investment terms and drop the mic?
No, it sounds like a good idea, but no, I don't do that. But I did write that book has sold over 3.5 million copies, and your whole idea is get rich education, and the basic part of education is understanding the language. And a lot of people are very intimidated by the whole language of finance. You know, the brokers, they know it and you don't know it. And so you're just supposed to pay them because they know what they're doing and you don't. Since 1984, literally, tried to help people understand the whole language of finance investment. And it changes all the time. The new tax laws and just new words all the time. That's why every 3 or 4 years we do a new edition.
Well, one of those words in that dictionary is leverage, and you and I have talked about the concept of leverage to create passive income before, and by leverage, we're not just talking about financial leverage, so tell us more.
So leverage really is the key concept in being successful in any business, particularly producing passive income. And by leverage, I mean using the skills, knowledge, experience that you have combining it with the skills, knowledge, finances of other people or organizations to create something that each of you can't do individually, but together you can. It's 1 + 1 = 3, I guess you might say here. So I'm just to give you an example in my case. I do what I do. I'm doing these books. I'm on radio, TV shows, all of what I do, and I help people in all kinds of ways. And there's loads of financial service organizations that I've worked with for many, many years, and I help them get customers. They do their thing. I refer people to them. The customer gets a great deal that they couldn't find out about otherwise. And so I get something every time somebody goes there. It's like an affiliate relationship. That's leverage for me. And I don't have to go do those things. I can just refer people to them, and I get something from it. So they benefit by getting a customer. The customer gets a great service they didn't even know existed, and I get a little something from it. So that's an example of leverage where your upside is completely unlimited. Otherwise, your life is limited by the amount of time you have trading it for money. And you only have so much time, so you only can limit yourself to so much money. Think of a Bill Gates, okay, who started in his dorm room at Harvard doing software. Well, he's now worth, $50 billion or something like that, because he leveraged his knowledge into a company. And then there's lots of people working at Microsoft, and he's getting income from that, right? So you don't have to just do it yourself. You can leverage yourself with other people's efforts and time and talent, and it's just amazing how far you can go.
That is truly expanding your means rather than spending your faculties and efforts living below your means.
Exactly. It's a concept a lot of people do not really understand. And I mean, in your world, for example, if you're doing rental real estate, you don't have to fix the place up. You don't have to manage it. All these things, there are people that do those things. And you have to kind of organize it and kind of run the ship. But you don't have to do each part of the thing. You see what I mean? You don't have to renovate it. You don't have to clean it. You don't have to collect the rents. There are places will do that. You're leveraging their capabilities for your benefit. So they win, you win, the person renting the house wins, and that's a classic case of what I would call operational leverage.
Sometimes maybe the everyday person that does work a day job and they're thinking, well, I don't really know if I have a new idea to be a Bill Gates. But, the interesting thing about real estate investing is you don't need to have an original idea at all. If you will build your team and leverage their faculties and resources, like you mentioned, and basically follow a template someone else put out there for you, you can put a 20% down payment or less on a property and leverage 80%. So you're leveraging the bank's money 5-to-1 right off the bat. And you didn't really need to do any out of the box thinking. You just needed to know that you want to be expansionary.
Kind of follow a template, right?
Yeah. So in real estate, there's kind of this rabbit trail laid out for you, I think better and easier than there is if one wants to be just sort of a general entrepreneur or start a new app or have a new business idea. Well, yeah, it really is about the concept of leverage. And so it's not just financial leverage. And like you touched on, Jordan, we're talking about building our team and kind of leveraging their faculties and their resources and their contacts and their knowledge of the local landlord and tenant act. I think a lot of people that try to do it themselves and not use leverage. I think the thing that I would say to the person that's trying to take on everything themselves and self-manage and be that every person is how many people can you serve if you try to do it all yourself and you don't lose leverage? Bill Gates asked himself a better question decades ago, and that's why his net worth is $50 billion, because he serves more people.
Exactly. And so it's better for you. It's better for the customers. It's better for the renters in your case. So it's an idea that's not taught in schools. In schools, people are taught to be employees, where you're basically trading your time for money, for salaries. And that's it. There's no leverage on that. I mean, the only leverage would be an employee if you get stock in the company, and then you're benefiting by the efforts of all the employees in that company. That's an example of leverage, I guess you might say. But it's a different mindset to leverage your time, expertise, ideas, those of others to benefit. And one leads to another in unpredictable ways. I've been doing this for 35 years. You just do things to help people. You don't know how it's going to come back to you, but it does in some unpredictable way. I like just to create a lot of positive karma out there. I mean, I didn't have to send you my books, but I just figured it would be helpful. So there you go. So I just like to help people. And there's a whole culture which is called dolphin culture as opposed to shark culture. Dolphins swim around in schools and help each other defend themselves against any attacks. And they just give without any expectation of return. Sharks are out for themselves, and it's a zero-sum game. Either they get the prey or another shark does. If you think of being in dolphin culture, you're going to do far better than if you're in shark culture, because sometimes you're going to be in the losing end of the sharks, whereas dolphins always protect each other. And it's a good kind of analogy to use, to give, and then eventually it'll come back in you in ways that you cannot possibly predict. So it's nice to be around dolphins, because when you're giving, something's going to come back at you. You don't know exactly how or when. But for example, in the case of real estate, it's all about deals. And you want to be in a position that people are going to tell you about potential deals. And if you give something to them, that's what you can get back from them. So just think of being a dolphin with leverage, and you'll do just fine.
Yeah, I think people naturally feel that sense of reciprocation when someone shared with them. And, I think overall, as we migrate closer to and become more and more of a sharing economy, this is a really good thing. I mean, do you want to go out every day and live in a culture of sharks with sharp teeth, or live in a culture of dolphins? And one can think of another person or another company as competition, or they can think about a sense of collaboration. And would you rather live a life of competition or collaboration? I think most people would say collaboration.
It takes a mindset to do that, because there's a lot of people that are very competitive, and it's a zero-sum game. If they win, I lose. I always say, how can the two of us create something together that's bigger than the two of us individually? That's always the way I think about every relationship. And not all relationships work out that way, but I give it a try. And more of them work out than not.
Yeah, and that is truly leverage right there. Jordan, you and I have talked about commercial real estate funds and how someone can go ahead and get on the debt side of a transaction rather than being an equity investor and create a stream of passive income that way. Tell us more.
So yes, so for some people who don't want to get their hands dirty at all, don't want to buy real estate, but still want to get passive income from real estate, it's a good thing. These are called commercial real estate income funds, and there is a website related to them, which is commercialrealestateincomefunds.com. They've also got a phone number, which is 888-444-2102. And what they do is they make loans to commercial real estate projects over a pretty short time, 1 year, typically about 1 year to 18 months. Because the Dodd-Frank and the other financial regulations have made it really difficult for people to get commercial loans, they do these loans perfectly secured in a much faster and easier way than going through traditional banks. And not only do they get a loan, but you, a fund shareholder, participate in the profits of the fund. So when the projects are sold, 80% of the profits go back to the fund shareholders as well. So it's kind of unusual. You're getting income plus a bit of an equity kicker. That might be another 1 or 2%, the profit sharing on the back end. So I'll just give you an example of the kind of project one of them did recently. Guy had a big house in a college town, I think it was Boulder, Colorado, that he was renting out to 2 students. He got a loan from the fund. Took about a year. He completely renovated the house and made it into 4 apartments, 4 doors, 4 bathrooms, 4 kitchens. So a year later, he's got double the income from the same house that he had before. Local bank wouldn't touch him. Okay. So the value of that house went up dramatically when the cash flow was double what it was before. He then sold the house at a profit because it was worth more, and shared some of that profit back with the fund. This is the concept of what's called forced appreciation. And that means before you even get involved in the project, you know it's going to be worth a lot more, not relating to what's going on in that particular real estate market. So that's an example of one. Another one they did recently was a large house with 1 elderly person in it. It was taken over, and they made it into an assisted living home with 6 people in it, with a nurse's station. So the same house had 6 times the income instead of 1, with people on Medicare or something like that. So again, the same house is repurposed to have much, much higher income. So you're creating appreciation, and therefore when you sell it at a profit, you do well. So this is something that most banks don't want to get involved in. They think anything with renovation or construction is too risky. And so there's a market open for funds like this. Now, the particular people at the fund I just mentioned have been doing this forced appreciation strategy for about 35 years. Millions and millions of dollars they've done this way. There's tons of deals that are needed because people can't get traditional loans from banks. Anyway, there's a way. So you as the investor are getting 8% monthly checks. You want to take them, fine. If you want to reinvest them, that's fine as well. You can do it inside an IRA. You can do it regular account. So instead of having your money sitting in a checking account or savings account or CD earning zero. I've just given you a way to earn 8%, and there's no commissions involved either. 100% of what you invest gets the 8%. And that's completely passive on your part. You don't have to do anything. You just have to give them a check and just receive checks. That's as simple as it is.
Well, I don't really see a lot of deals structured this way that have that 1% to 2% equity kicker at the end. Okay, so we have 8% monthly check. So if someone invested $100,000, they get $8,000 per year divided up into 12 monthly checks. Okay, so just to back up, so a lender like you, the listener, you give money to a loan originator, and that loan originator then gives that money to a business person that's buying a property. Since we have the Dodd-Frank Act, and we don't need to get into the nuances of that, but since that's basically weighed heavily on banks, business people just can't get those short-term loans from banks. And see, that's a problem for a business person that creates an opportunity for an investor lender like us.
Exactly. And I frankly don't think that's going to change. They're talking about weakening the Dodd-Frank Act, and they may around the edges a little bit. But banks are very, very scared. The regulators are all over them. Basically, they say to banks, never take any risk on any human being for the rest of human existence. It's like, okay, so I can loan to AT&T and Exxon. Great. But how about a guy who wants to rehab an apartment building or something? Nope, too risky. So you're exactly right. Overregulation in Washington has created an opportunity. And here, you as the investor can take advantage of that by being in this commercial real estate income fund.
Whenever there's a problem somewhere, an opportunity is going to surface somewhere, and potentially this is where it is. Well, let me ask a little bit more about this then, Jordan. When does the investor get their money back?
Earliest day they can get their money back is 18 months. And after that, you can get it whenever you like. So there's minimum hold time of 18 months, and it's going to go on for 10 years. So you can get your money anytime you want. The vast majority of people in these kind of funds just hold them for regular income. Either if they say they retired, they want to live off of it, or say you have an IRA, and this is kind of an alternative to traditional fixed income instruments like bonds, or what I call bond surrogates, things like utility stocks, real estate investment trusts, master limited partnerships. They have high yields, 4 or 5% yields, maybe, but if interest rates rise, as they have been lately, you're going to lose a lot more in principal than you're gaining in interest. Whereas with the commercial real estate income funds, there's no market fluctuation whatsoever. So even if interest rates rise, it does not affect the value of your principal.
Okay, and you gave some examples earlier on the types of property that are being secured, like with the 4-unit property or with the assisted living home there. What's the loan-to-value ratio that the lender is lending on?
The maximum that they'll do is 70% loan-to-value, maximum. Often it's less than that. So that means that the borrower-developer always has at least 30% skin in the game, and sometimes more than that. So they're not going to walk away. They've got, the guy who's doing that rental house in the college town, he knows that when the project is done, it's going to be worth a lot more. So he is committed to making that project happen because he knows his income is going to go up and he'll be able to sell it at a profit. So the default rate is almost zero on these kind of things. And the specific people behind the fund I just mentioned have an extremely extensive checklist. In fact, last I checked with them, they have a 1,200-point checklist that they go through before they'll go ahead with the deal to make sure, because they've done this for 35 years, so they've seen everything possible go wrong, and they put that on their checklist to make sure the finances are solid, the people are solid, the real estate values are there, and it's just very, very super solid.
Yeah, because that really sounds good. So that just makes me think about more risks because it does sound good. I imagine part of that 1,200-point checklist is the loan originator, make sure that title insurance is purchased, that appraisals are done, and so on.
Every detail. Yeah, there's a lot of detail. And this is why I like that it's passive, because this is not something I do. This is something that they do. I'd rather just give them money, let them do their thing, and I just collect the checks. This is the ultimate in passive income.
Passivity is so important, Jordan. I talk about it on the show all the time. As investors, we have all these metrics: capitalization rate, internal rate of return, cash flow. But maybe the most important investor metric is one that you'll never see on a Microsoft Excel spreadsheet, and that is, what is your return on time invested? If an investment's truly passive, your ROTI, your return on time invested, goes through the roof. Just one more question, and I really want to remind listeners, typically don't let the tax tail wag the dog on these things. We have Rich Dad advisor Tom Wheelwright for Taxes Come On. Even he himself says don't let the tax tail wag the dog. But what are the tax consequences for this type of income when you make a loan?
The income you're getting is taxable to you in the year you get it. You'll get a 1099 on that. Now, if you hold it inside an IRA, a regular IRA, or even better, a Roth IRA, money would be growing tax deferred in a regular IRA, tax free inside a Roth IRA. So you decide where you want to hold it. It's taxable outside, tax deferred inside an IRA.
We're talking with America's Money Answers man, Jordan Goodman. This is Keith Weinhold. You're listening to Get Rich Education. We will be right back. Are you looking to invest in your first investment property or grow your existing inventory? Highlands Residential Mortgage can help, offering down payments as low as 15% and credit score requirements down to 620. Their streamlined process is designed to help investors close their loans quickly and without any surprises. You need someone who knows cash flowing real estate and can help guide you through the muddy waters of today's lending environment. So call Graham Parham today, toll free at 855-326-6802. The Parham team can help you purchase or refinance any of your 1 to 4 family investment properties.
NMLS number 195724, 12001 North Central Expressway, Suite 750, Dallas, Texas 75243. Equal housing lender, not licensed in all states.
As a lot of investors know, multifamily real estate has been one of the best asset classes to be invested in most of the last decade. While the great deals have been harder to find lately, there are still opportunities in select markets where savvy investors can get lots of appreciation and strong cash flow if you have a great team. Dave Zook, founder and president of The Real Asset Investor, and his team have been very active in the multifamily space in Memphis, Tennessee. On the heels of the Great Recession of 2009, Dave and his team quietly started acquiring multifamily assets, and in the last few years, he has syndicated over 2,000 apartment units, creating strong cash flow streams and big appreciation for lots of their investors. It's not too late to get involved. If you're an accredited investor and you would like to learn more about investing in great multifamily apartments with a world-class team, email Dave and his team at info@therealassetinvestor.com.
Hi, this is Russell Gray, co-host of the Real Estate Guys radio show, and you're listening to Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education with our guest, America's Money Answers man, Jordan Goodman. So, Jordan, several months ago, we had a change in presidential administration, and that really created, I guess, more of a shakeup than a lot of administrations do. So let's talk a little bit about how Donald Trump is going to affect the real estate market, in your opinion, and let me know what you want to think, but maybe we should take this with a grain of salt, because whether you support Donald Trump or not, I don't know that we can necessarily call his behavior predictable. So let me know what you think.
Well, he's not predictable, but I think the policies he's trying to implement are pretty predictable. So let's assume for the moment that what he's talking about actually ends up happening. May not, but let's for the moment say it will. He is, by the way, the first real estate president. And we've never had anybody as president who was his main profession before was to be a real estate investor, right? So He understands real estate extremely, extremely well, has been very, very successful at it. So several things. First of all, when you lower tax rates, it increases your after-tax cash flow, right? So that's a positive thing right there. So he's talking about cutting the income tax rates on individuals from currently there are 7 rates down to 3. And my guess will be the 3 rates would be 33%, 28%, and 12%. Could be changed, but that's my guess right now. That brings a lot more household cash flow to people, particularly at the higher end where the current top rate is 39.6%. Meaning they can invest in real estate, afford more real estate, and that's very, very, very positive for the real estate market to have taxes cut at the individual level like that. And the same is true at the corporate level. A lot of people own real estate through corporations. The current rate is 35%. He's talking about lowering that to 15 to 20%. And again, if you own real estate in a corporation, like a subchapter S corporation or sub C or LLC, you're going to get to keep a lot more of that rent. So that increases your cash flow dramatically to have lower taxes on the corporate side as well. So that alone is very, very, very positive for real estate.
In years past, you saw from time to time people be concerned that, maybe the home mortgage interest deduction will be eliminated or at least capped, or you saw some other things, people getting concerned in the media about, will the 1031 exchange go away? Because a lot of people basically perceive that as a tax break for wealthy people. So I really don't see any threat of either of those things going away or being capped or diminished in the Trump administration myself.
I think it's possible there could be some limits on mortgage interest deductions. In return for having the tax brackets come down, they've got to do something to raise revenue. And I think one of them is capping mortgage interest deductions at $1 million or maybe $500,000. I'm not sure what it would be. But I think that is one possibility. They're not going to wipe out the mortgage interest deduction completely, but I think it is possible. I mean, this is all subject to negotiation. And so I think it can't look like he's just giving the store away to rich people, okay? So he's got to have something politically to say, yeah, their rates are coming down, but they're going to have to pay more on their tax because the deduction is limited to some extent. So we'll see, but that's my guess right now is, and I think rich people would be glad to make that trade. If they're going to get their income tax to 33 instead of 39.6, they're willing to give up some mortgage interest deductions.
So since we do have a real estate guy in the White House, outside of taxes, you do have a lot of people asking, okay, as real estate investors ourselves, how is Trump going to help us? What would you tell those people?
Well, I think he could increase the tax benefits for real estate as well. I mean, depreciation. I mean, one of the things he's talking about is being able to expense any capital expenditure right away instead of having to depreciate it over time. That would be very positive for real estate as well, because you'd be able to expense it right away, any construction costs, renovation costs. So that would be a very positive thing too. So there are potentially other benefits, and he knows these things well, to encourage investment in real estate. We have a shortage of real estate in this country, not every market, but in many markets we do. If you look at the overall numbers, we're adding about 2 million new households per year in America, and yet we're only building about 600,000 or 700,000 new units. And remember, every year, a certain number of units are destroyed. Floods, fires, tornadoes, earthquakes. We lose some housing every year as well. So we're not keeping up with the demand for all these new households coming in. Now, in some markets, in San Francisco and Austin and Miami, and there's just not enough housing available. And you get multiple offers because the supply-demand imbalance. Now, it's the opposite of like 10 years ago when you had too much supply and not enough demand. But that also helps the real estate market. And that's why real estate prices in general have been rising, particularly in these hotter markets. If Trump's policies, we talked about tax cuts, infrastructure, deregulation, all these things, if they stimulate the economy, as we think it will, that's all positive for real estate. Real estate ultimately is a play on employment. And when people move into a town, they have to work. And when they're working there, they got to live somewhere, either renting something or buying something. So when the economy gets stronger, that means real estate prices go up and appreciation of real estate and cash flow goes up. So all those things are very, very positive for real estate.
Yeah, it's interesting. Sometimes people get into these nuanced discussions about, what are tax rates potentially going to be? And you can just look at the fundamentals of supply and demand. There are 325 million people that live in this country. That number is going up. They all need to live somewhere, and they all need jobs. And part of those jobs in a Trump administration is, you think about Trump's pro-business policies. And pro-business policies, that's typically something that's antagonistic to higher interest rates. And most people see us as being in a higher interest rate environment in the near future. We've already had increases to the Fed funds rate. So any thoughts about higher interest rates flying in the face of a pro-business Trump administration?
Interest rates are definitely going to be rising. We've had the Fed raising rates. I think they were going to raise them a total of 3 times in 2017. But it's telling you that they think the economy is strong enough to be able to withstand higher rates. And the difference between now and, say, a year ago, had I told you the Fed was going to raise rates 3 times, the stock market would have plunged at that point. Right. But now it's been doing pretty well. In fact, it's soared dramatically since the election because Fed raising rates is considered a sign of strength and confidence that the economy is getting better. So yes, rates are going up. Mortgage rates are definitely going up, but they're still at relatively low levels. And on the margin, some people may not be able to afford 4.5% mortgage where they could afford a 4% mortgage. But if people have better jobs and their cash flow is better and all these things are happening, that's going to overwhelm the higher interest rates.
I want to ask you a question. I think I already have my answer to this, Jordan. I want to see what your answer is. Okay, say a year ago, if there was a really good jobs number reported by ADP, that caused some fear among investors that, oh no, that means they're going to hike rates to cool an overheating economy. And that would often create stocks to move down. So basically you've got good news, good jobs numbers, meaning stocks go down. But now this year, if you have good jobs numbers, stocks don't go down. They might even go up. What's the difference?
Yeah, as you said, last year, good news was bad news.
Yep.
This year, good news is good news.
Right.
That's a big difference then. And I agree with you, because the feeling is when you get more jobs, there's more income, wages are rising, more people buy stuff, consumer purchases are going to go up, you're going to get more corporate profits going up, and investors too. There's tons of investors still on the sidelines, still traumatized by 2008, frankly, even though that was a long time ago. And so there's even a small amount of that money. There's about $10 trillion in CDs and money market funds and savings accounts sitting on the sidelines earning zero. So even a small amount of that coming into the stock market raises stock prices as well. So that's why this kind of positive cycle. John Maynard Keynes, the famous economist, used to talk about reawakening the animal spirits. And that's what we've got here. People feel better, and it creates its own positive, virtuous cycle, I guess you might say. That affects real estate, that affects the stock market. It creates what's called the positive wealth effect, meaning people feel wealthier. And even though they're not selling their real estate or selling their stocks, they go out and spend because they feel better. And that helps the economy.
Yeah, I think the difference is Trump exuberance. That's why last year bad news was good news, and this year good news is good news. It's due to Trump exuberance. Whether that's justified or rational or not, I don't know. It just seems that that's the difference. That's why good news is good news.
And that's a big change. But I'm just saying in the real estate market, a lot of it's based on confidence. And remember what happened in 2008, and the real estate market was just falling apart. People were walking away from their homes. They have a nice name. They called it strategic default. And the banks used to call it receiving jingle mail, which is people would be sending in keys in the mail. And that was the jingle mail that they were getting. So what a difference between then and now. Nobody's walking away from real estate today. They see it's going to be appreciating, and they're putting more money into it all the time.
Yeah, we don't follow the gyrations in the stock market very closely on this show because it is a de facto sentiment indicator on how people are feeling and how much of that wealth effect might really be out there. And just for maybe the listener that doesn't understand why higher interest rates can go ahead and slow business growth is because when you have higher interest rates, just imagine if you yourself, if you wanted to borrow to start a business or if you wanted to borrow to buy a fourplex building, well, you're just that much less likely to do so with higher interest rates.
What's happening is interest rates are going up for what you are charged on loans, like mortgages, credit cards, car loans, but the banks are not raising what they're paying on deposits. Bank profit margins are widening here, and that's why the bank stocks have gone up so dramatically. And it's unfair, but it's true. That's just what's happening, is you keep your money in savings accounts and CDs and think that rates are going to go up when the Fed raises rates. Not happening. They're just keeping it at pretty much zero while they're charging you more on loans. In the past, that would have happened, but this time, I don't think it's going to. And that's why I mentioned before the commercial real estate income funds as an alternative, where you get 8% instead of keeping your money in the bank, pretty much earning zero.
Yeah, that's a great point. And I guess I wouldn't know because I don't save my money. I invest my money. So, Jordan, even as the federal funds rate rises, you don't see savings accounts rise, or they just haven't to this point?
I don't think they're going to for a long time. The banks love inertia, and people keep their money there, and they just seem to be inert. It's not as though they're going to lose the money. People aren't going to pull their deposits if they don't raise the interest rates. So banks love inertia, and they love it in many ways. They love it on the savings side and on the mortgage side. They love people to be paying mortgages for 30 years, all the interest up front for many, many years. And that's why the banks have all the big buildings in town.
Well, one of Robert Kiyosaki's famous sayings is savers are losers, debtors are winners. And you've got to temper that a little bit. He's talking about investing with smart debt, with cash flowing real estate. So even in a higher interest rate environment, savers still could be losers for the long term.
And they will be. I mean, if inflation is starting to pick up, not a lot, but it's over 2% now, I would say. And if your money's sitting in the savings account earning zero, you are a loser, I would say. That's correct.
Okay. And
even if interest rates are higher, it always depends on what the alternative use for your money is. So if you're investing in getting 6, I talked about an alternative to get 8, and your cost is 3 or 4, you have a positive arbitrage. If your cost is 3 or 4 and you're earning 1 or 2, then it's not working for you. So you have a positive arbitrage where you're earning more than you're paying.
Well, Jordan, you've earned the moniker America's Money Answers Man from your decades of experience because you can answer basically any type of question from consumer debt to real estate to stocks to loans to currency devaluation to terrorism's impact on the economy. And so really, I just want to open it up wide open for you here at the end and just ask, is there any opportunity out there that most investors or just everyday citizens are missing out on that they really should be taking advantage of, but they're not?
Well, let me tell you I'm going to solve a problem for people that don't even know they have this problem. Okay. And what that is there's loads of mortgages that have the wrong payments. And it's because they're adjustable and they're tied to some index like the LIBOR index or National Housing Index. And often these mortgages are sold from one servicing company to another. And there's a tremendous amount of mistakes on people's mortgages. And so there's a way of doing an audit of that where you can actually see if it's wrong. And there's a website for that, which is called checkmyarm.com, adjustable rate mortgage loan. They've got a phone number too, which is 800-647-8253. And they do an audit. They see the original document. They see what payments you've been making and what the index is and all that. And in many, many cases, they told me recently there was a guy that was owed $8,000 from having been overcharged for many, many years in his adjustable rate mortgage. And then they prepare a letter and they say, here's the contract. Here's what he should have been paying. Here's what he did pay. This bank is the amount of check that you need to send back to them. And now this is what the new payment should be. And the banks kind of have to admit that they got caught. So that's checkmyarm.com. And also in the real estate market is the same thing with escrow. Escrow is where you have to put money aside for property taxes and insurance paid through your bank. In many, many, many cases, people are withheld in their escrow, and there's more in there than they should be. And it's the same thing. Checkmyescrow.com and the same phone number, 800-647-8253. They have helped people for years lower their escrows and lower their ARM payments and literally get thousands of dollars in refunds. So it's a problem you probably didn't know you had, but I've just solved it for you.
Right. So when there's an escrow excess there, is it just that banks aren't returning it annually or in a timely fashion?
Never return it. There's no way they're going to return it. And in fact, they probably raise it again. And they say, the property taxes and insurance are going to go up. Well, they may or may not. So there's a lot of money that you're paying as part of your monthly mortgage payment into that escrow that's sitting there doing nothing where it could keep working for you. So again, banks love inertia. And, they're overcharging you on your adjustable rate mortgage and overcharging you for your escrow. So now I've given you a tool to fight back.
That's something we all might be able to act on to increase our personal cash flows. Jordan Goodman, where can our audience connect with you?
So my website is moneyanswers.com. I love to help listeners like yours, and there's all kinds of links and videos, and I'm glad to take emails as well. There's a little Ask Jordan button. People can tell me their stories. I call them back and just love to help people. We talked about the dolphins earlier. I can be a dolphin with your audience and just try to help with no expectation of anything in return.
Thanks so much for doing that for our listeners. Jordan Goodman, thanks so much for coming on to Get Rich Education.
Thanks so much, Keith.
Well, yeah, a really wide-ranging discussion with Jordan there. Now, just a minute ago, Jordan let me know that it's not Check My Arm and checkmyescrow.com. Rather, it's Verify My Mortgage and verifymyescrow.com. That's in the show notes for you. So as we're here in a rising interest rate environment, and we've had 3 different quarter-point Fed rate hikes over the last 16 months, and that's after the rate was essentially at 0 for several years, well, banks are just not raising interest rates on deposits, and I guess I wasn't quite aware of that before talking to Jordan here. I guess I wouldn't know because I'm not a saver. It doesn't pay to be a saver. I'm an investor. So yeah, savers still project to be losers for a while. There's really a lot to appreciate about Jordan Goodman, his longtime contribution in all types of media, and that fact that he isn't just knowledgeable about a wide range of financial topics, but the fact that Jordan makes things actionable for you whenever you speak with him. He often tells you about a resource, then he leaves you right away with a website or a phone number right along with that resource. Again, Jordan's website is moneyanswers.com, where you can use the Ask Jordan button to connect with him, and he will answer you. Tell a friend about Get Rich Education. We're here every week to help you build your wealth. And last month, we launched a revamped Get Rich Education Android app where Android users can now go straight to their Google Play Store. And for free, you can grab the Get Rich Education app and have the GRE icon right there on your phone's desktop, so it's easier than ever to listen to the show. Special thanks today to America's Money Answers man, Jordan Goodman. Next week, we're back with the Rich Dad Advisor for Real Estate, Ken McElroy. Until then, I'm your host, Keith Weinhold. Don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.